with Sridhar Sivaraman. Where is it that he's spotting any green, if at all, in this market? Sridhar, hi, good morning. Welcome to the studios as always.
Thanks for inviting me.
We've seen this play out many a times. This time it's two different countries. Where is it going to end, and what should the market read into the latest developments?
Yeah, if at all any of us knew where and how it will end, one is only hoping that this ends fast and doesn't prolong for too long, because unlike the Russia-Ukraine war, which was more in the hinterland and it was literally landlocked, didn't affect too many people apart from little bit of European impact. This has impact on crude. I mean, we import almost 50% of our crude from the GCC countries, and a large part of our LNG imports come from there. Remittances come from there. So this has a larger impact if this continues for a longer period of time. So one would only hope that this gets resolved faster and doesn't prolong as long. But if it does prolong, then we do have an issue. The general view is that this doesn't prolong for too long, and some sort of normalcy will come back. I don't think this will be 100% normalcy, so it does have an impact. I don't see crude come back to the 60 handle in a hurry. Maybe it will come back once all the production comes back. So in the short term, I think it's a negative for India. That's how I would put it. But our markets has corrected, so I guess a lot of it is already priced in. That's how I would put it.
Correlate that with Sridhar, the rupee. I mean, the fact that we already breached 92 yesterday, that's going to push back the FIIs even further, right?
Yeah, so I think one of the reasons for FIIs selling and in the last 18 months more so is because Asia is going through, I would say, an earnings super cycle. So this year, Korea will have the market will have 100% earnings growth. Even the likes of Taiwan will have, say, 25 to 30% growth. And this is broadly the AI related, because the chips and the DRAMs are in short supply. But even China earnings growth is somewhere in the 15 to 18% bracket. So I think that's the challenge, that India has struggled with single digit earnings growth for the last 18 months. We think that earnings growth for the next year, which is FY27, which starts from 1st April right now, we could come closer to the 15% handle, which is a good news. But when you compare it with Asia, when I speak to my ex-colleagues and friends in New York, they say 15 is great, but your valuations are 20 times, whereas Taiwan, Korea, China are almost at single digit. So that's the challenge, that there's a super cycle of earnings going on. Korea has had a lot of volatility, but that market's still up 30% for the year. Year to date, it's up 30%. So I think those are the challenges we are facing. I think it'll take some time for the FIs to come back. That's my view, because of the
relative outperformance of the rest of the world
and the relative opportunity.
Yeah,
that's the challenge.
Sridhar, how do you look at this entire geopolitics from a macroeconomic point of view, especially absorption of the shock, which either in terms of crude or in terms of gas, and over the last 10 years or 15 years, we have made a conscious effort to move away from coal and others to gas-based production, whether it's for steel or for any other industry which is there. What could be the impact in that sense?
So it's very difficult to exactly pinpoint what the impact would be. As I said, if this prolongs for more than a month or say 2 months, then we have a massive impact. The broad view is this doesn't happen, but we do have an impact. As I said, that if we are importing 50% of our crude from GCC, almost 30% or 40% of our LNG comes from this area, 50% of remittances come from this area. So we have multiple macro touch points which come from the GCC countries. We may not think them, I mean, this is as a group of countries, so your gas is coming from Qatar, your oil is coming from many other countries. So unfortunately, this has impacted the entire GCC. That's the sad part, that even though the war is between two countries or 2.5 countries, it has impacted the entire GCC nation. So I think it will be foolish to think that this will have no impact. I think there will be significant impact in this quarter, because number of companies export a lot of reasonable percentage to this region. So we'll have to wait and see how this plays out. But my view is that it will settle down in a quarter's time. So I'm not saying like this is a screaming buying opportunity or something. You have to be very selective. We don't know how it plays out. So one has to take an informed view on it's more stock specific. Let me put it that way.
Because the markets have been able to absorb a lot of that stock shock. Actually, you don't see that in our markets at least. Of course, we have seen some correction, but the Nifty is still up 10% on a 12-month basis as we speak. So, of course, some of the sectors get impacted there, but from a macro point of view, do you see earnings recovery which we were expecting for FY27 may get hit because of that?
So actually the Nifty masks the problem that we have in the broader market. I mean, all of us know that the broader market has seen significant pain. So the Nifty also has been helped by a few sectors here and there. So I wouldn't just look at the Nifty, but as I said that I do think that the next year we will see 15% growth because we have a very low base effect. We've all had single digit earnings growth for almost 6 to 8 quarters now. Yeah. So I think it does flip because our base is low. So there is opportunity. I'm just saying that one has to be stock specific. This is not like, you just go whole hog and buy the entire market. We are seeing opportunities in the market, but it is not like a lot of sectors have their own headwinds. We can talk about it, but there are a lot of headwinds coming our way.
I will talk about headwinds, Sridhar. Very, very curious. But the first major headwind, at least to the Nifty, has been the IT index. Yeah. It's fallen 30% from the highs. And oftentimes, when things like this play out, they are also met with huge opportunities. Yeah. You believe it's an opportunity?
So I have to say that in our own firm, we have differing views, and these are my personal views. Sure. And I've been very negative on IT for over 2 years for exactly this reason that, the AI impact. And my broad view is it's not like these companies are going to die tomorrow, their revenues are going to become zero. The terminal value is eroding. So it is a P derating event, which a lot of people are missing. I've seen a lot of the founders coming and defending their stock. This has nothing to do with the company. The company stays, it will make profits. I give example of the media sector. Go back 10 years and see the large media companies and the view was OTT will not affect them. Are these companies still existing? Yes. Are they making profits? Yes. But the profit growth is flat for the last 5 years. The P's are single digit. So this is a derating event. I don't think these companies die, but like in a recent conference, one of the large IT company CEO in the conference said that in hindsight, we made a mistake by not investing. This has become a deflationary industry. For the first time, I've seen somebody admitting a problem. If you don't admit, how do you solve the problem? Yeah. So I think this is a problem not only for the IT sector, it's a problem for the larger employment related stuff because total number of employees in this segment, you're not hiring people. It has a second derivative impact, which is much larger. I think this is for the government to have a serious look at this. I don't want to sound alarm bells, but as far as IT sector is concerned, I would still stay away from it. As I said, I don't think these companies are bad companies. These are great companies with cash flows, but I don't want to fight a derating event and try to find the bottom.
But Sridhar, there's of course that debate about what to do with IT services. But the other debate is, do you really play the AI trade sitting here in India? And the opportunity is via data centers, is it energy? How do you, treat that piece?
I don't think we have a clear AI play. I mean, that is the ground reality. No FIs coming to India to play the AI trade. The AI trade, as far as Asia or emerging market is concerned, is in Korea,
outside
Taiwan.
India, yeah.
And their earnings are real, their cash flows are real. They're taking advance from these companies to even put up capex. So they are seeing massive cash flows. I mean, those profits are real profits. You can say it can be cyclical because this is a cyclical trade. But the point is that I don't think there is a clear AI play. FIs don't come to India to buy some small mid cap which is very niche. So if you look at from a broad space, there isn't any AI play. And I think we are AI consumers. That's how even globally people are looking at it. That's the sad state that our IT industry had enough cash flows to invest in this. but unfortunately, they decided to distribute it back to the shareholders in their wisdom, and now they're coming out and saying that maybe in hindsight we made a mistake. Our R&D is 0.5% of our revenues, and some of the CEOs in closed door meetings say that India Inc. needs to take it up by tenfolds. This is a problem for India Inc. So I think it's a chicken and egg story, but that's the reality.
I remember, a couple of years back, a large company CEO had to exit because he was investing in AI at that point in time.
Yes.
Yeah, I don't want to get into the specifics here, but I mean, it's sad if that was continued, maybe that company would have looked very different today.
Yes. Sridhar, you look at macro numbers very closely.
Yes.
You had inflation and WPI and the GDP number recasting that happened.
Yeah.
What's your take on inflation now? Because you predicted last year that inflation will be much lower than what RBI is looking at.
Yeah.
Now, with the new set of numbers metrics which have come in.
So what I would say is that at least based on the numbers that we have with the new data series that we have looked at, I don't see rates going up at least for 9 months. It's very difficult to predict beyond that because so many things are changing. Keep in mind that even if oil prices go up, the crude goes up, in the CPI what matters is the retail fuel price, which has been flat for 2 years. So it can have second derivative impact, but doesn't have direct impact on CPI to that extent. So we do think that inflation will be in the band of 3 to 4%, at least for the next 9 months. Beyond that is very difficult to foresee. I don't see RBI changing their stance. I don't see RBI increasing rates. So we will see lower rates for longer. That's how I see. I am not expecting any rate cut, but I am not expecting a rate increase either. So we could see this status quo where rates remain where it is right now. Just keep in mind that the government hasn't benefited from the rate cycle because the 10 years still higher than where we started.
And it's inching up as well.
Yeah, but the consumer has benefited, which a lot of people are missing. You get mortgage, if your credit rating is good, you can get a mortgage at 710 to 725 from a PSU bank. You can get a vehicle loan today at 775. So there has been transmission of this rate cycle, which may be bad for the banking sector in general because it's deflationary and the profit pool is coming down. But there has been transmission. Consumers have benefited from the rate cycle. That's how I would put it.
Why do you
just kind of follow up. So on the banking system, of course, it's been deflationary. Do you believe that we could start to see profit growth this year, just given the fact that credit growth has picked up as a result? Also, it probably is the worst over where banking is concerned?
So I have a very non-consensus view on private banks because of this. I think private banks, the large private banks, have a serious problem because we just did a deep analysis of the PSU bank results last quarter. You take the top 6 PSU banks, excluding SBI, their retail loans have grown at 23%, home loans at 17-18%. This is the BOBs, Canras of the world, the PNBs of the world. I'm leaving SBI for the moment because they have done even better. Vehicle loan at around 20%. This entire pool, this 6 banks, about 60 lakh crore is their total loan book. I compare this with the top 3 private banks, their loan book roughly 60 lakh crores.
Correct.
Their home loans growing at 6-7%, vehicle loan at 1%. They've literally ceded space to the PSU banks. So the earlier view was that private sector banks keep taking market share from PSU bank. That trade has flipped. What has happened is they are lending at say 725 on the mortgage, 775, 8 on the vehicle loan. And their view is our target is 275, 3% NIM, 1% ROA. We are getting that with this. A private bank cannot operate at that space because he needs 1.5-2% ROA, otherwise the markets will slap them. So this is a major problem that, and then now look at SBI, their 60 lakh or 40 lakh crore loan book, and they've grown at almost 15-16%. Their gold loan doubled last quarter, year on year. So I think there is a serious deflationary problem. The profit pool of the banking sector is coming down. The large private banks are in a tough spot. That's how I'll put it.
And I guess that's
yeah.
reflecting in the way the prices as well have been moving. I mean, look at what HDFC Bank and ICICI Bank have done off late.
Yeah, so I guess
I guess the market knows always.
I guess the market is looking at it because if you want to grow above system, then you have to grow in all the segments. If you're vacating space in mortgage, in vehicle loan, in gold loan, then how do you grow above system? Because corporate loans are far and few, and there is a deflationary effect there also because the pricing is very thin there. So how do you get profitability and how do you get the higher ROAs that banks are wanting and the guidance in the market? So I think that is the challenge.
So like PSBs, what is the other, or rather where do you see the next profit pool getting created?
So I think the profit pool creation is very stock specific right now. That is the problem. So
You won't give us stocks, which
I will not,
which is why I asked
unfortunately, which is
sectors.
why in the beginning I said this is not a market where you just go whole hog and just buy everything. Like I said, private banks, you have to be selective. PSU banks, we are bullish on PSU banks, but again, very selective. Can you buy all of them? Because if the ROAs are going to be 1% or in and around that, and suppose there's a credit cycle which comes up. Today the credit cycle is very benign. If it comes up, then what happens? So I think one has to be careful there. The IT industry is a question mark. We don't want to pay 50 times for a consumer company which grows at 5%. So I think that is the challenge. On a top-down basis, there is a challenge for the market. On a bottom-up basis, there is opportunity. Unfortunately, I cannot speak on this.
So far, the private banks have been, chasing profitability, and at this ceding away their market share to the PSU banks. Do you think that at some point in time, banks would say that okay, we need to get back our market share even at the cost of profitability?
I think they're already saying that, which is they want to go one notch lower in terms of the credit standards, which is if you were lending at 750 to 800 as a prime customer on mortgage, which they can't now, so they're going one notch lower, which basically means that you would in 12 months time or 18 months time, you could have higher NPAs there because you're lowering your credit standards, so you could technically get higher NPAs. It's a very tricky situation right now. So I think it's not black and white, but the broad message is that the profit pool of the banking sector is coming down.
And how do you see the valuation gap between PSUs and private sector? And now it's almost converging.
I think it will narrow further because I don't see the PSU bank profit valuations go up significantly, but their earnings are growing at say 10-15%. The private sector is also growing at that percent. In heydays, private banks used to grow at 20% earnings. Those days are gone. Look at the last quarter results and see the profit growth of the top 5 private banks. It doesn't seem like the profit growth is that high. As I said, this is a challenge for the bank. I'm sure they'll evolve, they'll find new strategies. On a bottom-up basis, we do find opportunities, but on a top-down basis, there is a challenge for the banking system in general. That's the point I'm making.
Interesting. Sridhar, very quickly, gold, silver. You called out the trade.
Yes.
What next?
Very bullish on both of them. See, gold is a different animal, so we can leave that aside because it's more geopolitical. As long as this Trump tantrums continue, gold will remain, very firm. It's also a hedge against the currency, and as Aisha mentioned, currency is at 92, benefits gold immediately. Silver is also an industrial, commodity. We are bullish on base metals. Copper is the most bullish space. Unfortunately, very few plays in India. Aluminium will do well. These are all the AI, the solar, the electrification, EVs. For everything, you need more and more of these base metals, including silver. So silver is in short supply. So it is not only a store of value, it also is an industrial commodity. So yes, does it help if it moves from 50 to 100 in 2 days or in 5 days? It doesn't help. So I'm happy that a lot of them have corrected. Sanity will prevail. Speculators will move out. But if you ask me over the next 3 years, 5 years, will silver be in triple digit? I think yes, it will be. So there are companies which benefit from that. You have to be patient and hold on to it. There'll be volatility in this, but I'm quite bullish on base metals. I think people have stopped investing in real assets. In the previous cycle, if you go back, what has happened is that as soon as metal prices went up, promoters used to use the cash and make obscene acquisitions at very high valuations. This time around, not only in India, globally, the companies are returning cash. They are not wanting to invest. So this is not a very good sign from the pricing standpoint, because even if the demand grows at 3 to 5%, there isn't enough supply. And I think there is a serious problem. This will be a problem for Indian corporates also, because this will be inflationary.
What's the latest on your wildlife trip? North Bengal?
Did you manage
To
time?
get-
Is the
did
bigger
you get to
question.
see the red
In
panda?
this
outside.
market?
No, it's better to be outside because you'll end up making some mistakes. So we don't have to trade, on a daily
Yeah, you
basis.
don't.
But I was trekking in North Bengal. I went with a group called Nature Explorers, and it's a beautiful place, near the mountains in Himalayas, where we were looking for an elusive animal called red panda. And then it has, Himalayas is the place for very exclusive birds. It was, quite remarkable, trekking 4-5 hours a day and looking for some of these exclusive birds and the red panda. It was quite amazing. And when you go deep inside, Indian, Bharat, as we say, then you realize, it's a completely different world. They're not affected by the war. They're not affected by what's happening in the daily stock markets. They have a different world altogether, and it is thriving. I can only say that that part of the world is thriving. Only thing I can say is that Bengal still needs a lot of infrastructure development.
Yeah.
I mean, having traveled across India, I can say that I think Bengal lacks on the infrastructure side. I mean, just a 90-kilometer stretch took us almost 3-4 hours. So I can say that is something which Bengal needs to invest. Otherwise, it's a very beautiful place, especially the northern part of Bengal, which is not very well traveled.
Well, the pictures, of course, are mesmerizing. What colors and the red panda, must be quite a sight.
Yes, it was.
Okay, on that note, to many more trips, thanks as always for your time.
Thank you for inviting me.